It's the early 1970s, and Stanley Goldblum, Chief Executive Officer of Equity Funding Corporation of America, has just given his financial targets for the next quarter to management. The goals seem outlandish, impossible even, but Equity Funding, one of the largest insurance companies in the country and a stock market darling, will hit them. They always hit them, because all they have to do is fake it. Before we dig in, I just want to say how crazy it is that an event like this has such a low profile. This happened within the last 50 years, was one of the largest financial crimes in history at the time, and spawned a book, a TV movie, and a major Supreme Court case. Yet I hadn't heard about it until reading about that case for my last video on insider trading. See if you can figure out which case it is before we get to that part. Anyway, Equity Funding of America had two main lines of business, which were selling mutual funds and life insurance. As the company grew, they began making acquisitions to diversify the business into things like banking, energy, even cattle. They were able to make these acquisitions in part because they went public, giving them access to capital by way of issuing stock. Shares initially listed for $6 in 1964, and even then, there was already some fraud happening. Goldblum had convinced his treasurer to book fictitious loans receivable, essentially to show that the company had more business than it did. The intention here was to make sure that the company had a successful listing by presenting stronger financial statements than they could otherwise. From then on out, it seems the company got caught up in needing to always show improving numbers to serve Wall Street, and that's really tough to do when the numbers you're trying to beat were fraudulently created in the first place, unless you just go and create even more fraud. They probably overdid it though, because by 1969, just 5 years after IPOing at $6 per share, Equity Funding Corp was trading at $80 per share with a market cap of $420 million, worth about $3.5 billion today. The reason investors might have bought the story of this explosive growth was that they were touting themselves as financial innovators. They specialized in something called the program, which combined their two main business lines into a single product. First, clients would give them money to invest in mutual funds, which, sidebar, at the time they were able to charge 7% commission to do this. Today, people cry about management fees that are fractions of a percentage on ETFs. So things have changed a lot. Anyway, they would take this money and then say, hey, do you also want some life insurance? Presumably the person would be like, I don't know, is it expensive? And the sales guy would say, no, with the program, it's basically free. The way it worked was they would use the mutual fund investment as collateral and issue a loan to the client. This loan would then be used to pay the annual life insurance premium. In the subsequent year, the value of the loan would be increased to pay the next year's premium. This would repeat until at the end of the life insurance term, the full value of the loan would come due. At that point, a portion of the mutual fund shares would be sold to cover the principal and interest. The pitch was that you got the life insurance for free because the investment would make more money over time than the total cost of paying off the loan. This is not actually all that innovative though. Maybe it was for the time, but think of it like this. The program is just taking a margin loan and buying insurance. It's kind of the Silicon Valley-esque rebranding of something, like calling a bike with an iPad on it a fitness revolution. But this gave people cover to believe the financials were real, so it accomplished its job. Now, here's the thing about committing fraud that's just moving lines around on your financial statements. It's cool and all, but it doesn't directly give you any money. You can issue stock, sure, but Stanley decided to up the game. Around 1969, the fraud evolved. But first, remember, all this time, the company was running a real business. It just wasn't as successful as it appeared. There were people buying life insurance and investing in mutual funds and taking part in the program. One way the company generated cash from all this was to sell their insurance policies to a reinsurer. Basically, Equity Funding would sell the stream of premium payments to a different entity who would then bear the risk of holding the policy. Equity Funding would be compensated for making the sale and keeping up the administrative work. Well, Goldblum found his golden goose in this. he would sell policies for people who didn't exist. There were a lot of problems with this plan though, but apparently it was the best option they had. The first of these problems was technical. They would need all these policies to tie into their financials. Thankfully, technology was just rising to meet their needs. Their computer guy, who kind of tragically was really into it, but just because he got to do a lot of coding, set everything up so they could tell which accounts were fake and which were real and push everything through to where it needed to go. Among the many reasons it is so strange this crime is poorly known is that it's the first major instance of computer-aided fraud. The second problem was that each policy couldn't just exist as a line in a spreadsheet. Their auditors were going to need to see some documentation. Insurance in particular involves a lot of paperwork. To solve this, they threw what were basically fraud parties where dozens of people would stay in a house together and fake whatever needed to be faked. In the slow periods, they would drink and use whatever drugs were popular at the time. The third problem was the quick infusion of cash they were receiving came with an obligation to make future payments, which had to come from their accounts since these imaginary policy owners couldn't pay them. The only way they had to make the payments then was to set up even more fake policies that themselves would turn into liabilities in the future. Sure, they could kill off some of their fake people to end the payments and even collect their payouts, but they were careful not to do this too far out of line with what would have been expected according to actuarial tables. In retrospect, maybe they could have faked a plane crash or something to collect a bunch of payouts all at once and keep things going. Anyway, they didn't think of that. And this third problem really was the kicker, because it was almost like they had built up a Ponzi scheme, except they were at the top, but also at the bottom. It wasn't the problem that ultimately got them though, even though it would have eventually. It was that second one. The manpower involved was just too much. When you have over 100 people and they know a secret, it's only a matter of time. In 1973, Equity Funding fired an employee named Ronald Seacrest, who had been to the fake document parties. He went to the regulators and to an analyst in the space named Raymond Dirks to blow the whistle. Dirks got his clients all to dump their holdings in Equity Funding before rumors of the regulators closing in started to chip away at the stock price. Shares made it all the way down to 14 before trading was halted, and a few weeks later the company declared bankruptcy. It was uncovered that they had produced upwards of 50,000 fake policies with face values of nearly $2 billion. 22 people were indicted, all of whom either were convicted or pled guilty. Stanley Goldblum was sentenced to 8 years in prison. Raymond Dirks beat his insider trading charges after taking his case all the way to the Supreme Court. In the aftermath, investigators inspecting the fake paperwork tried calling the phone numbers provided with the life insurance policies. In almost every case, random people picked up who knew nothing about Equity Funding. The forgers, it turned out, hadn't even been thorough. It was just people didn't want to look too hard. Thanks for watching, guys.